Every economy that relies on expanding credit for growth eventually faces a liquidity trap, where lowering interest rates and relaxing lending standards fail to stimulate asset appreciation or consumption. This stagnation occurs for two primary reasons. Households become reluctant to take on additional debt, or they find themselves unable to afford more debt, even at lower interest rates. China, too, is grappling with a middle-income trap, characterized by wealth concentration among the elite, while rural populations continue to earn meager incomes. Unlike during the 2008-09 global financial crisis, when China played a pivotal role in stabilizing the global economy, such intervention is unlikely to be repeated under current conditions, as the causal factors have shifted. The remarkable expansion of global credit and debt illustrates how solutions can inadvertently create deeper problems. While infusing the economy with low-cost credit can be effective when debt levels are manageable and pent-up demand exists, over time, as an economy becomes saturated with debt, the ability to sustain further borrowing diminishes. The burdens of existing debt increase the risk of default, creating a precarious situation. The global debt surge has been built on the fragile foundation of the everything bubble, where soaring asset prices have expanded the collateral available for loans. However, once this bubble bursts, collateral value declines, leaving lenders exposed as assets fall below loan amounts, leading to a crisis with no viable escape route for borrowers or lenders. Demographic shifts exacerbate the situation. As the baby boom generation exits the workforce and begins liquidating assets to fund retirement, the question arises: who will purchase these assets at current inflated valuations? Younger generations lack the capital and income necessary to invest at these levels, and no immediate solutions appear to bridge this gap. This sell-off is likely to depress asset prices, further eroding the collateral underpinning global debt and igniting a credit crisis that cannot be mitigated simply by loosening credit conditions. The principle of diminishing return suggests that applying failed strategies will only accelerate instability rather than reverse it. Regarding the optimism surrounding AI as a potential savior for the economy, it's essential to recognize that what many perceive as transformative changes may actually translate into significant costs rather than productivity gains. Historical trends, such as the productivity gap in the 1980s, demonstrate that while new technologies were adopted, their anticipated productivity benefits often did not materialize promptly. If AI does eventually enhance productivity across the economy, it may take years, if not a decade, for those benefits to manifest. In the meantime, the current credit asset bubble that is deflating cannot be salvaged by advancements in AI. As for how the deflation of the everything bubble will unfold, Richard Benugli and I explore two primary scenarios in our podcast: how asset deflation could play out. Massive deflation with stagflation. This scenario resembles the 1970s, where the real-world value of assets collapses, even as nominal asset values rise. For instance, when the Dow Jones Industrial Average surpassed its previous high of 1,000 in 1982, investors felt reassured. However, they failed to realize that the purchasing power of those stocks had plummeted by 57% since the market's peak in 1973, and by an astonishing 66% since 1966. The future trajectory of asset values hinges on the emerging causal conditions, making it crucial to closely monitor economic indicators and trends.